Dear clients, I'm Richard, Senior Phillip CFD Dealer. US equity drifted higher last week in thin summer trading, with the Dow Jones Industrial Average clawing its way back into positive territory for the year, and the S&P as well as the Nasdaq Composite also ending on a higher note. However, as the Q2 earnings seasons of generally better than expected corporate earnings winds down, expect market participants to shift back to data and policy watching mode in search of further market directions. On this note, let's start off with the US economic front, whereby last week's calendar was relatively thin. Nonetheless, there were some notable figures, namely a disappointingly flat July's retail sales growth and the University of Michigan preliminary reading on consumer expectations also declined for the fourth straight month, apparently set back by weakness in hourly earnings. Ironically, these anemic data points translate to good news for the market, as temporary stalling of wage growth and weak consumer sentiment indicates subdued inflation pressure for now, and hence provides the Fed with more room for policy accommodation. Next, to reiterate this point on the cross-market front, a myriad of weaker than expected developed economies data, ranging from Japan to Europe, besides the US, continues to suggest an uneven global economic recovery, thereby also furthered expectations in recent weeks for a continuation of the low interest rate environment. For instance, we noted that the yield on the 10-year German government bonds, known as Bunds, fell below 1% for the first time ever, following Q2 GDP prints showing that Germany's economy contracted slightly, while growth for the entire Eurozone was flat. Indeed, the meager yields available on other safe haven sovereign debt added to the attraction of the US Treasuries, thus driving the 10-year Treasury yield below 2.35%, its lowest level in over a year during last week. Last but not least, in terms of geopolitical situation in the Middle East and Ukraine, these pockets of global unrest remain extremely fluid, which undoubtedly weighs heavily on investor sentiments. For instance, after signs of conciliation drive equity gains last week, the situation in Ukraine appeared to relapse on last Friday morning as news broke of a confrontation between the Ukraine military forces and the Russian armor convoy yet again. However, the overall effect of global geopolitical tension on equity markets is arguably unclear, as it also generates safe haven bid that contributes to the very low interest rate on bonds, which has counterintuitively heightened the relative appeal of equity markets. Hence, in summary, the confluence of events, both geopolitical and economic, allows market participants to trade very dovishly. In other words, the current market risk-on trade is largely premised on policymakers' pace of interest rate hikes to be very gradual. So the question to ponder upon is, how distant are market expectations versus that of the policymakers? Well, to have a sense of it, futures contracts on the federal funds rate shows market participants currently expect the benchmark to rise to 0.63% at the end of 2015, while the FOMC's media projection for the end of next year is at 1.13%. Let's keep our finger crossed that the market participants are not making a mistake on the policy debate front. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks which are available with Phillip ETFs. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Richard from Phillip CFD. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.